Broadcom just reported earnings and the numbers are massive. AI revenue more than doubled to $8.4 billion in a single quarter. Let that sink in. This is no longer a side bet. AI is now Broadcom's entire growth story. So what does Broadcom actually do? Most people think of them as a boring chip company, but they've quietly become the most important player in custom AI silicon. When Google needs chips for Gemini, when Meta needs silicon for their AI data centers, when Anthropic needs to scale Claude, they go to Broadcom. These aren't off-the-shelf GPUs. These are custom-designed processors called XPUs, built specifically for each hyperscaler's workload. Now let's talk about what just happened with the stock. Broadcom closed at $317, up about 1% on the day. But here's the thing. It's actually down about 5% over the last 6 months and sitting 25% below its all-time high, near $425. The stock got hammered into promise in the broader AI sell-off even as the business was accelerating. That disconnect is important. Let's break down the actual numbers. Revenue came in at $19.3 billion, beating estimates of $19.2 billion. Earnings per share hit $2.05 versus the $2.03 that Wall Street expected. But the real headline is that AI revenue, $8.4 billion, up 106% year over year. That crushed their own guidance of $8.2 billion, and they're guiding Q2 revenue to $22 billion, with AI making up $13.1 billion of that. The growth is actually accelerating. Here's what really sets Broadcom apart from the competition. They control roughly 70% of the custom AI chip market. NVIDIA still dominates overall with 81% of all AI chips. But that's GPUs. The shift happening right now is that hyperscalers are moving toward custom silicon because it's more power efficient and cheaper to run at scale. Marvell is the main competitor targeting 20% share by 2028, but Broadcom has the relationships. They've got 5 major hyperscaler customers now, and they just landed an $11 billion order from Anthropic. Their AI backlog stands at $73 billion. But there are real risks. The geopolitical picture is messy. The US slapped a 25% tariff on AI chips in January. China is retaliating with rare earth export controls. Taiwan, where TSMC manufactures most of these chips, remains a concentration risk. And Broadcom's valuation at 66 times trailing earnings isn't cheap, even though the forward PE of 22 looks much more reasonable if they hit their growth targets. The VMware software business is stable at about $6.8 billion a quarter, but growing slowly, so the AI story has to keep delivering. So after running Broadcom through all 6 dimensions of our AI scoring model, here's what we got. 6.4 out of 10, a B grade, bullish. Profitability is a perfect 10 out of 10. 36% margins on $64 billion in revenue is elite. Analyst consensus is a 9.2. Basically, the entire street says strong buy with an average target of 453. Growth scores a 6. Solid, but not as high as you'd think because the overall revenue growth of 16% is lower than the AI segment alone. Valuation drags it down to a 3.2 because of that 66 times PE, and momentum is only a 5 since the stock is down from its highs, despite the business performing. Our AI model puts the 1-year price target at $395, about 25% upside from here. Wall Street's consensus is even more aggressive at $453, and the 5-year target sits at $483, implying over 50% upside. Given the $73 billion AI backlog and a path to $100 billion in AI revenue by fiscal 27, these targets could even be conservative. If you found this breakdown useful, hit subscribe and follow for more AI stock scores and earnings breakdowns. And as always, this is not financial advice. Do your own research before making any moves.